So we're up to ratio analysis. Ratio, first of all, you do not need to memorize all the ratios. I think I've mentioned that. I give you the sheet for the exams, so you can refer to that while you're taking the exams. You do need to know how to use the ratios, which is really the key thing. These ratios, they're measuring relationships between financial resources and, I guess, financial outcomes. That's one way to look at it. And so there's a rationale behind it. The firm has resources. It's converting those resources into profits by selling goods or providing services. And so the ratios kind of relate one to another to see how it's doing. The one good thing about ratios is that they standardize the data so that you can compare it year to year, rather than just using raw numbers, which are not as easy to analyze going from one year or one company to another. So we can, when we look at ratios, you don't just compute a ratio and say, okay, all done, that's it. You have to look at how that ratio compares to how that firm did in the past, over the past 5 or so years. You also compare it to how other firms in the same industry are doing, and so you're using what's called intercompany, which is comparing one company to another. That's intercompany. Whoops. Intercompany. You're comparing this company with other companies, or intra-company. These are just terms that you're going to run into. Might as well kind of get them down. Intra-company, that means within the company. So that would be over the past few years with this within the company. Intercompany, you compare it with other companies. And you can compare it to industry averages. Okay, so different types of ratios. And again, you don't really have to know which one's liquidity, which one's profitability. As long as you know how to use the ratios at this point, that'll be fine. But liquidity, you need to know these terms. You'll run into them as you're going along. Liquidity, it's the ability of the company to meet its current obligations. Can it pay its bills that are coming due this period? So liquidity ratios would be things like the current ratio, which is your current assets divided by your current liabilities. And that really answers the question, do you have enough current assets to pay your current liabilities? That's what that's all about. So liquidity. Acid test is a variation of the current ratio. Gives you the same sort of information. And then they put the accounts receivable turnover, a few different turnover ratios in that as well. Your inventory, accounts receivable, these are your operational ratios. Then you've got profitability. Profitability, the ability to generate profits from the operations of the company. And so these are sort of looking at profits relative to various different resources used to generate them. So you have the profit margin, asset turnover, return on assets, return on common stockholders' equity. All of these are what you would call profitability ratios. And then solvency. Solvency is the long-term ability of the company to stay in business, to survive over the long term. And here you get into things like the debt to total assets ratio, or times interest earned. And there's a bunch of other ones too, but basically if you've got debt to total assets, obviously if a company has debts of 1,000 and assets of 20, that's going to be problematic. As opposed to a company that has debt of 20 and assets of 1,000. This company is going to have a hard time surviving in the long term, and maybe even the short term. Okay, so limitations of ratio analysis. If you're comparing ratios to industry averages, it's sometimes hard to classify a firm, say, gee, what industry is this? Because a lot of firms have so many, they're all consolidated, so there's a lot of different types of businesses in them. But that's nothing you really, and then the accounting practices, that varies from firm to firm. Some firms use LIFO, some firms use FIFO, and those you have to make adjustments if you're seriously using ratios to analyze companies. Also seasonality. the time of the year. Some businesses have a lot of activity towards the end of the year, some at other times of the year. You know, think down on the Cape, those businesses have definitely different averages in the summer than they would in the winter. Okay, so how many ratios do most analysts use if you're really looking at analyzing financial statements? They're not going to go through every ratio that's provided in the book. Most will have a couple of profitability, a couple of liquidity, a few, you know, solvency ratios that they use. So they may use 5 or 6 to kind of get started on looking at how they think a company's using. They try to figure out which ratios apply best, you know, to the particular company that you're looking at. And then how many years do you need to analyze? Usually at least 5 if possible, 3 to 5, 3 minimum to 5. It gives you a little bit of a, you can see the trends over time on how a company, how the company is doing. So no one ratio is going to tell you magically how the company's doing. You have to, you know, these are part of looking at a company. So you're looking at the financial statements, you're looking at this, you'll at the ratios, you'll do some vertical and horizontal analysis, you read the financial press, all of that goes into the analysis. But in the next video, we'll just get to how to actually calculate some of these ratios.